What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Steve Johnson. How you doing today, Steve?
Hey Dan, I'm good. I'm doing very well today. It's the end of the week. It's Friday. I'm ready for the weekend. It's good.
Sweet, sweet. And I got some extra special great news for you, Steve. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, investors, buyers, sellers, syndicators, you name it. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of a private off-market deal that you're not allowed to publicly discuss, also known as a 506B syndication, then you should also know that the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants and shut down your business, which is bad. So that's what we're up to, and the advantage to you is you'll learn how to more effectively communicate on the subject of commercial real estate and understand how my guest fits into those deals. But before we get too excited about real estate, Steve, do you want to say a thing or two about yourself?
Yeah. I'm Steve. I'm here in Miami. I love it down here. Been here about coming up on 3 years now. But I have traveled, kind of been all over the country. I used to work in theater as a technical director, which for anyone who doesn't know what that is, it's basically an unlicensed general contractor building shows, designing the shows. So I learned a lot of my rehab there. That's how I got started in the game, was rehabbing mobile homes in parks. That has since transitioned into property management at various properties over time. I'm now with a team where we have mobile home parks out in the Midwest, a lot of them out in Illinois. So I oversee a lot of the operations remotely. I love the remote working thing. We use a lot of virtual assistants to help with business growth. And then I've got another business where we are buying distressed debt. Right now, that's in the single family space, and we're expanding more and more into the multifamily commercial debt as well. So that's a little bit about me, and I'm an open book. I love networking. So if anyone wants to reach out, my contact info I think is going to be there on the screen,
Sure is.
and just connect with me.
Excellent, excellent. It sure is. And that brings us to the first segment in our show, which is the five distinct motivations. Before I do that, I always say, but wait, check your eight. Steve, I don't know how you are with technology or not. Maybe you can see through the camera into the audience's device. Down there, there might be this hideous subscribe button. They could get rid of it for free. It's just, the thing. Okay, it's a dumb joke, but whatever. I do. But
I'm laughing because I'm the guest. I'm going to entertain that idea. There we go. It's good.
there we go. Good stuff. So let's talk about motivations. I've now interviewed over 350 different syndicators, investors, deal sponsors, all that kind of stuff. And I've met a whole whack more. And everybody has their own unique why as far as what brings them to commercial real estate deals, what gets them involved. And I found, even though they are unique, they fit pretty neatly into these five different categories. And the reason why it's so important to go through them is because these deals take months to close, they take years to go full cycle. So you need to have some sort of indication before you partner what's going to keep this person from throwing in the towel when the going gets tough, as it will, because all businesses have risks. Now, the first of those five is preservation of purchasing power. What's that? Some people, they they already have a portfolio of assets and they're job optional. They don't need to have a W 2 because they make ends meet with the proceeds of ownership. If you're in that situation, it might seem like everything's all fine and dandy, so there's no need to make an acquisition. So, why do people in this situation make new acquisitions? Well, there are two reasons that stand out most. One of them is if inflation is rearing its ugly head, that's going to eat away from the purchasing power of your cash flow, so it's going to be time to make a new acquisition. The other time is when you can buy at a steep discount, which is what people always should try to do as much as they possibly can, but that steep discount might be because of distress, divorce, death in the family, retirement, things like that, or it might be because of a full out asset crash, meaning that you can buy at that steep discount and make sure that you're not going to lose your principal from that. Now, full disclosure, I'm not far enough in my real estate career to say that this is one of my main motivations. My one is trading time directly for wealth. And that stems from the fact that if you've ever been a high salary, high wage earner or anything like that, me personally from tech, that fits the bill. What happens is you find out that your tax bill gets bigger and bigger and bigger. And if you're like me and you start doing the tech for real estate companies, I was doing the online funnels, the mass emailing, the credit card transactions, handling all the IT for a group that was flipping 10 houses a month. And it hit me. It's like, this is ludicrous to be negotiating for more and more salary when it's just going to go straight out the door in the form of taxes. So that is why I started trying to get rewarded for my effort in the form of little slivers of deployed capital. So that's what I'm up to. And I get that that's a little bit abstract for especially youngsters. Youngsters, they tend to want to hustle like crazy right now and fast track their retirement. But the more universal need or desire, motivation that people have is just wanting to take control of their schedule. A lot of people want to be free from the W-2 and maybe work fewer months per year, fewer weeks per month, or whatever it is. But the mistake that a lot of people, where this is a primary motivation, comes in is they think that everybody secretly wants to retire and do nothing. And I assure you that's simply not the case, and it's particularly evident in this sector. Specifically, you've got some people who are fueled by ambition. They want to buy their entire hometown. They want that generational wealth to make sure that their great-grandchildren never have to hold a day job. And they're like, I'm sure glad that grandpa or grandma, whoever, pursued commercial real estate. That makes lots of sense. A lot of people these days are sort of vilified for having that level of ambition, and I don't think that's particularly fair, because you need somebody in the fold who's not going to throw in the towel. They're going to be hustling into their 90s, and that's how you have nice properties that are great places to live or do business in, whatever type of commercial real estate you're doing. But there are other people who are also going to be hustling into their 90s, but it's not so much about their own generational wealth, their own reputation, or whatever. They've picked a sector of society, or maybe it's animals or the environment. Who knows what it is? But there's a financial component to making a really big impact, and that's why some people are pursuing commercial real estate. So, Steve, of those 5 different motivations, what combination of them would you say describes you best?
Boy, I would say retirement is probably the biggest one there. I used to be in the hustle culture. That was how I started out. I got into the wholesaling in the very beginning, and I'm a believer that wholesaling is probably the hardest route to go. I'm in that camp. You got to know the most. It's a constant job. You got to hustle. You have to expand, and you're gonna screw a lot of stuff up. At least I did. So I found that that wasn't for me. But now at this point where I'm at with my business is I want to be working myself out of a job essentially. We've been growing our businesses the last couple of years here and bringing on more, growing out the team, bringing on more virtual assistants. They're taking over more of my things, which frees me up to do the next investment. So for me, it's constant. I would say it's the retirement, so I can move on to the next thing and move on to the next thing and the next thing. And then, of course, I really do connect with this last one here that you have where helping people. I love training others and coaching the other people on our team. As we hopped onto this call, I was just telling you about how I had a great meeting with my direct report. We have weekly one-on-ones with them, and it was a good meeting. It was productive. We hit a bunch of topics. I'm coaching her through how to work with her direct reports and address some of the concerns. And I love giving that back.
I love it. I love it. And one of the things for this next part I need to emphasize, though, it's really pretty common that when we talk about motivations, you seem a little bit starry-eyed, optimistic, all that sort of thing. So we need to bring that back into some of the harsher realities, which is there are risks involved. This is a very mature industry. It's one of the most mature industries out there. But if you've ever been involved in one of the private deals, the 506B syndications, whoever the securities attorney in the mix was, and there better have been one, or else that's the biggest red flag there is. You should run away. But they should have insisted that everybody fills out a suitability questionnaire, some sort of questionnaire to document your substantive relations. And as I was going through the more or less standardized questionnaires, the one question that bugged me a bit was the tolerance for risk assessment question, because I found it didn't matter which option you chose, it didn't give me, it lacked utility. It didn't give me really usable information. So for this interview, I made my own one, and it's a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Steve, it can be inside real estate, it can be outside real estate. What's too risky for you to invest in?
Restaurants. That's something I have no interest in. I've only heard that that's like the toughest one to get into. I am not into the Bitcoin space, the cyber currency stuff. Mainly because I don't understand it and it seems speculative. Again, I don't understand it. I'm going to take Warren Buffett's advice. Don't invest in what you don't understand. So
Mhm.
I'm just not there. Maybe I'll get there sometime. You won't sell me on it right now.
Right.
Um, and then as I guess for let's see, any other asset classes I can think of. Oil right now. I
Mhm.
just it's another one I don't understand. And that's more or less not because it's risky. It's just I don't understand
Yeah.
that
Yep.
asset class. I really understand the real estate world. I understand larger multifamily. I've actually gravitated over time away from the single family stuff, and I'm much more pro multifamily commercial scale. Go and scale. You're going to learn a lot more. You're going to crash, and you're going to pick yourself up faster when you've got a lot of stuff moving and transactions happening.
I love that answer, especially because, like, when it comes to crypto, it's an appreciation move, and no level of knowledge changes that. It's buy low, sell high, or lose. Like even in oil and gas, at least it can be used for energy. It's not just, people speculating, as you said. So I love that answer. Now, of course, I don't want to alienate a bunch of people. And for the first couple hundred chance encounters, I didn't include this slide here, the favorite deal metrics, because I know that some people in real estate, they're more like a PR, a front of house, a marketing, the face of the business, rather than the person who's going to do deep dives into spreadsheets, tweaking different assumptions and things like that. So I didn't want to alienate my guests. What's the point of having a podcast just to make guests feel bad? But I found that even the people who are that front of house, they're going to have some metrics that they tend to hone in on to use and discern one deal from another. And for anybody in the audience who is just listening and not watching, I'm going to read out the 14 different metrics that I have on here, which is not an exhaustive list. Heavy duty underwriters definitely will be considering more factors than these, but here they are. The first one is cash on cash, then it's IRR, which is internal rate of return. Then you have the cost per door. Then you have the net operating income. You have the going in cap rate, which really means how much of a discount are you getting compared to local buildings that are similar. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy rate, which is the inverse, in other words, the same thing basically as the vacancy rate. Then there's the average income where the property is located, the amortization period of the loan, especially important if you're going to be assuming it. There's the difference between the market and the in-place rents to show how much you can bump realistically. There's the population growth where the property is located, so you have some baked in appreciation from demand and population population growth. There's the sponsor record, which is how many deals have already gone full cycle, how many deals are on the go right now. There's the waterfall split or exit strategy, which is talking about what happens to your investment after your principal has been returned. Then there's DSCR, which is debt service coverage ratio, which is how much of the revenue from rent is going out the door immediately, just in the form of the loan. So once again, that's not an exhaustive list, so feel free to choose another one. But Steve, do you want to give a top three or something like that?
When I'm doing mobile home parks and mortgage notes, when we're buying delinquent mortgage notes, we're looking at cap rate and loan interests. Like those are the big ones there that stick out from that list for me. It's all about what is that discount I get on the front end. It's you got to buy. You make your money on the buy. So that is where I'm looking probably the most. The next thing I would actually say, which I wasn't saying maybe 2 years ago, but I'm much more concerned about population growth and not necessarily growth, but just population, only because I have found a lot of our markets have been more secondary, tertiary markets, and it's not the problem isn't finding the tenants and the clients. The problem is finding the contractors, is what even when it comes to lawyers. We have mobile home parks that are in rural markets, and our VA who handles evictions and tracks them, she's got significantly more experience than some of the attorneys in some of these more rural markets because she's going through a handful of evictions in just one quarter. That she's done more in one quarter than the law firm handled all last year. That was a recent interview we had with, checking out one lawyer. So population is actually the next big one. That's a big metric for us, is how rural is it, and can we find contractors when things start to go sideways to address the issues?
I love that. I love that. I'm just eating up that answer like a delicious subscribe sandwich. I got some very subtle messaging here. Well, really what it's for, it's to remind me it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And I go through all 6 of them in every episode because that is the main factor in you being able to learn how to communicate more effectively on the subject of a commercial real estate deal. You need to be able to say, hey, who are all these people? Why do they need to be there? What are they even called? And if you watch this explanation and you think to yourself, wow, I really need to get me one of those, the good news is it's absolutely free. You can go to dandoesdeals.com and there's this great big button. You just click on it and it gives you the PDF. You can print it out. And yes, you heard me right. I committed the cardinal sin of marketing, which is you should never, ever, ever give away your freebie without asking for some sort of contact information. But it's really important that you learn how to effectively communicate on the subject of commercial real estate if you're going to make it part of your career or investment strategy. So that's why I make it that simple to you to print out and practice it at home with your friends, family, and whatever. But let's get started. The most visible people in commercial real estate are the repositioners. They are the acquisitions people who are looking at a whole bunch of deals. They're talking to all sorts of brokers, walking a bunch of different properties, figuring out which ones are they actually going to pick up. And why they're called repositioners is because they need to figure out not only which one to buy, but also how are they going to change how it's run so there'll be a real difference in the upside. And if I were to put my finger on the most peculiar part of being a repositioner, it's got to be the fact that they have to have a wide network of financiers. Those are people who are not technically in the deal in the sense that they don't have any duties, because all that they're doing is dealing with the owners of the property and dealing with paperwork and the money itself to fund the deals. But of course, the reason why the repositioners need this vast network of financiers is because if they can secure a more advantageous loan, aka cheaper money, then that goes straight to the profitability of the property. So it's a lower expense. So that's why they need to know lots and lots of financiers. That's what they're up to. But the next place that a repositioner typically will check is they'll take a look at the operations, say, how do we get those Benjamins to stop going down the toilets? But of course, there's more to operations than just unclogging toilets and collecting rents and all that kind of stuff. Of course, that's a little bit of a multi-family lean. You don't have to fix as many toilets in mobile homes, I'd imagine, because it's kind of their problem. But when it comes to operations, you might ask yourself, hey, Dan, you're involved in commercial real estate, but well, actually, maybe you don't know this about me, but I'm from the internet. So the question might be, how can I end up being a GP and helping and contributing on these deals? And the answer is, first, there's the web-based applications, CRM, automations, and all that sort of stuff. But the bigger ones is even on bigger properties where I tend to be involved, and you have a third-party property management, the enemy in commercial real estate is vacancy, which means you need somebody on the GP team with some serious marketing chops to make sure that those units get filled, even if the property managers are dropping the ball. So that's how I contribute to operations. But of course, there's only so much wiggle room you have in operations to find more profitability. So the repositioner frequently gets a contractor team involved to upgrade the property. The idea being that the future residents would be happy to pay more in rent than the previous ones because it's a nicer place. But if only things were that simple. When you're talking about multifamily, sure, you can spend endless amounts of money on contractors. And in mobile home parks, it tends to be creating new pads, expanding the lot that you already have. But you can go ahead and gold plate the toilets in a multifamily property, but it's not going to give you a return on investment. And if you are on the internet like me, then you're going to need locals. You're going to need boots on the ground who can be at the property in an hour or two, because you can be certain that's not going to be me. I'd still be stuck at an airport, so I need somebody nearby. They're going to be keeping an eye on the contractors, make sure that they keep the schedule, they're not using subpar materials, that sort of thing, and then keeping an eye on the operations to make sure that they're not sloughing photographs and they're telling the truth about the different things that are going on. But for the next part of the explanation, let's do a little bit of a hypothetical. Let's say you decide to become a repositioner. You're an engineer or a physician or an attorney, something like that, and you say to yourself, hey, I know how to buy a house. I get my down payment and then I borrow the rest. So if my friends and I pool our resources, maybe put in 100K each or something like that, maybe we can take over that 350 unit apartment complex down the road. So you pool your resources, you turn around to the banks and you say, hey, I want to buy that building over there for tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you want to lend us? Well, this is the part that I think you should listen to very carefully, especially if you have a mentor or a guru or something like that, because they tend to gloss over this next part. The financiers are going to ask, who's your sponsor? Who's your KP? What's that all about? In order to be eligible for a commercial loan, somebody on the team has to already own a similar asset, because that shows to the bank that you're not just going to take the depositor's money or the investor's money and then run the property into the ground. So you need to have somebody who already owns something similar. And on top of that, you need a certain amount of liquidity to show you can run the business effectively. And among the ownership team, you need collateral, in other words, a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, Steve, I know what you do is multifaceted, and it sounds like you're getting more and more vertically integrated. But what are the pieces of the puzzle that you tend to focus on?
Definitely, my focus is mainly operations. I come from the world of property management, and so I oversee a lot of the boots on the ground, the contractor work. I get a lot of those things going, and I work directly with the park managers daily to help them keep things flowing. And when it comes to the note side business, the operations there is follow through on all of the legal tasks we might have in process and making sure, are we ticking all the boxes? Are we following through? Foreclosing on a mortgage note, for example, is a slow process. And it's very easy to forget where you were because nothing might happen for 30, 45 days. So you got to keep things moving very, very slowly, and you got to operate that whole process. So for me, it's operations. That's my cup of tea. Give me lists, checklists, platforms to manage everything. That's where I'm going to excel and bring something to the team.
I love it. I love it. So let's talk about people. And actually, before that, let's do buy box. I always do buy box first. The buy box, it really means like, what's your ideal property? And when real estate people are asking each other, what are you looking for? What's your ideal property? What's your buy box? We're asking about three main things. First one's geography. Where is it? Which state? Which county? Even which neighborhood? It could all absolutely matter. So that's going to be the first thing. Second one's going to be size. Now, most of my guests are in multifamily, and the way that you define size in multifamily is by the number of apartment units. So that unit count is how you can tell, and the reason why it's relevant is because the type of group that takes over, 10-unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 100 and 150 and 350 unit apartment complexes. So the size matters. Now, of course, in mobile homes, it tends to be the number of pads, and then there are other types of commercial real estate that go off of acreage or square footage, but size matters for that exact reason. But the third one is usually called class. I prefer the term desirability because there's more than one, there's actually two parts of class, and I call those the condition and the area. If you're talking about condition, we're talking about what kind of condition, what sort of shape is the building in? Is it really, really old and beat up, or is it really recently renovated or a new build? And does it have all sorts of luxuries and amenities that make it more exciting for people to rent from? That's the condition. When you're talking about area, if you're talking about residential like we tend to over here, the school districts where the property is located is going to be important, but every type of real estate, the crime rate where the property is located is going to be important. And then the other one is the old broker trope of saying, oh, location, 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 as if that tells you some sort of information. What they're really trying to tell you, in my opinion, is traffic, traffic, traffic. If a gazillion people pass by that property every single day, it's going to automatically be more desirable and add to its value. But both the area and the condition, the way they rank it, it's the same way as in grade school, where you have A plus at the top, and then A, and then A minus, and then B plus, and so on. So, Steve, as far as you and your team, I know that with the loans, it's going to be a little bit different. But as far as properties themselves, what's easier to say yes to and get started into due diligence?
With mobile home parks, we won't really look at anything smaller than 70 lots. And I would say maybe we've probably inched up more over time because we're all about scalability. If we're less than 70 lots and it's a rural market, it's going to be really hard to find and support, boots on the ground staff out there if there's just not enough units. That could be two or three parks in one area potentially. But we're gonna hire one person to oversee that. Bigger the better. Um, we've started out in tertiary markets. I would prefer to stay away from those at this point unless the deal is has a lot of improvement or there's a new Amazon warehouse going up down the road or something. Otherwise it would be secondary markets, not really primary markets because those are very oversaturated. Where most of our parks are in Illinois, so those blue states that a lot of people run from. Okay, well, we're more open to it. We're just as hesitant as everybody else, but we've gone through that process of how to get through all of the extra bureaucracy that might be there. And then some of the states I'm going to avoid it actually would be Florida because I feel Florida mobile home parks, they're speculative. Um, California, same way. Arizona, the Southwest, there might be some awesome deals there. Colorado, I know has some issues out there as well in terms of a lot of new legislation. So we're very careful about, what's the legislation against mobile home parks in some of these states, and where is speculation happening because everyone's flocking there. Yes, it would be amazing to own a mobile home park in Arizona. Wish I had gotten in 5 years ago because now it's not going to be it's not in our wheelhouse anymore.
Right, right. That makes perfect sense. So let's talk about people like I was going to earlier. It's absolutely my favorite part about commercial real estate, just simply because I came from different industries where people weren't that easy to get along with, like in tech, we're not social butterflies. We're not eager to meet a gazillion more people in our space. And that's the polar opposite of commercial real estate. I chalk it up to the fact that because it's multifaceted, everybody has their own separate role. And really at the end of the day, it's about more business. So we're constantly making new introductions, referrals, all that kind of stuff, even if we're not going to be on the team. But even though that's wonderful, we all have our own unique skill sets, which means we can disproportionately help some people more than others. We are all in this industry in the business of deploying capital, so everybody is eager to meet financiers, of course. But as far as people who are more active in the deals themselves, the sponsors and KPs, I'm always eager to speak to because after all, I'm from the internet, and also with my technical background, I tend to help people where it's a one to many rather than a one-to-one, so you don't have to have the 120-hour weeks like you need if you're going to be starting out as a local or a repositioner. But Steve, as far as who's out in the audience, if you have any 506B deals, don't go mentioning them in the same sentence as wanting investors. But who are you best suited to help in the real estate space?
Who am I best suited to help? I mean, I've got the operations world, so I'm all about systems. So anybody who's looking for that operations kind of thing to come onto the team, I'm willing to do that. I'm very big on turning that business, getting everybody rowing in the same direction. I'm a follower of the EOS system from Traction. Um, that's what I'm going to bring to the table. And then uh, I'll run those meetings. I'm big on running meetings efficiently, getting through the topic, assigning those tasks, who's doing what. I don't like to waste the time just talking and talking and talking about what we're gonna maybe do. Let's get some action happening. Let's do some stuff. I want to be that action taker that a lot of teams end up missing, not knowing. They might not have an action taker, and they don't know it because they're spending so much time talking, thinking they're doing.
Right, right. I love it. I love it. So I guess we're gonna have to get some swag, some cups or something, like a self-congratulatory stuff for the two of us. Say like no, or sorry, see, this meeting couldn't have been an email.
Yeah, yeah, yep.
Right, yeah, that's what a lot of teams need is somebody who is really clear on, a lot of time meetings don't have to happen, but sometimes they definitely do, and you need to stay on subject. So, if you want to talk to Steve, we're going to get contact information in a second. Me personally, I'm super active on LinkedIn. That's the social media platform that's best for reaching out to me. If you do hop on to Amazon.com, I've got a few different books available on different business related skill building. But if you are going to be raising capital, if you're getting into this industry and you're going to be taking on investors, I highly encourage you can pause the video and scan this QR code right here. That goes to the FAQs page of 506B Me. Especially if you're not accredited, it's going to be especially important. But it's the service that we offer to help you maintain and back up your documentation of your substantive relations with your investors, because even if your laptop falls into the bathtub, the SEC is still going to need to see that documentation to show you new people before you involve them in private syndications that you're not allowed to publicly discuss. But Steve, I see your phone number is on the screen and your email, but social media, phone, email, what's the best way for people to reach out?
I'm most active on LinkedIn, posting pretty much daily at this point. Posting about mobile home parks. Some I don't do a lot of mobile home parks. It's more for the note investing side and business management and business growth, and a little bit of my personal take out there. And you can find me on LinkedIn.com/connect with Steve Johnson. Steve Johnson was taken. Go figure. Who would have thought that? It's kind of a unique name, right? But
Right.
connect with Steve Johnson and find me on there, and I can send a calendar link and set up a time to chat with anybody.
Excellent, excellent. Yeah, you saw me struggling with how to pronounce it. Is it yeah, right. But anyway, that
Yep,
brings us
yep.
to our public service announcement, and it's not for you, Steve, it's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, like migraine like symptoms, it's probably because of the hideous subscribe button. You can get rid of it for free. You just hit the thing and it just goes, okay. Full disclosure, the reason why I want a bunch of people to hit the button is because then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And then as far as trade-offs for you, it means my videos may show up on your list of suggestions, but you can feel free to ignore those suggestions. I just really appreciate the fact that you spent this time with me. Just like Steve, I appreciate you joining me. This has been great.
Thank you for having me on, Dan. I really appreciate you opening me up and bringing me into your guest house.
Sweet, thanks. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B Me or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format It checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Fredenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot.
And maybe it's, oh, why did I see that?
Cool. Okay, I know what I'm going to do.
I know what you're going to do too. And
as you're talking, I'm like trying to. This is a perfect little game. I love it.
No, not that one.
I was actually like, uh-oh. I'm like, oh, no, okay.
And then you thought for a second, Emma, bad news, bad news.
I
Right.
see what you're doing, but I can't stop it.
You've absolutely pinned that one down.
Oh, yeah.
When did you take my queen? This is very distracting.
Yeah.
Oh man. Yeah, I don't like you so much, Dan. I'm just saying.
Finally.
I really. Let's be honest here. You'll probably never speak to me again. I'm just not coming back. I don't know.